Hey, I'm Tyson with Portfolio Planning. Today we're going to talk about some year-end tax planning strategies utilizing charity. Number one is we want to talk about incorporating a donor-advised fund. Donor-advised fund acts like a donation bank account where we get to donate or deposit all in one place, and you decide how you're going to distribute that later, like paying charity bills. The reason why using a donor advised fund makes a lot of sense is it's going to collect all of your contributions throughout the year, and it's going to give you one singular tax receipt at the end of the year. So it's really easy for your team and for your accounting team to know that we got everything, we captured everything, and you're going to get the full benefit of your charitable contributions. The other thing that donor advised funds do really well is it's going to build a log of where you've given money, how you've given money, and the longer you have your donor advised fund, the more you can establish your trends of giving. How much did you give last year to this charity? How much did you give last year to that charity? Are you missing out on something? And are there trends that you could be following that you're not following? Did you forget somebody? And your donor advised fund is going to give you a lot of information. So we partner with companies like givewise.ca, and they have a fully electronic platform that allows you to go on there and look up the charity in question. Say you have somebody come and knock at your front door. They're wearing a vest, they've got a clipboard. They said, hey, we're raising money for such and such cause, and we are a registered charity. You can open up your GiveWise account on your phone or on your iPad, and you can verify that they are registered with the CRA on the spot. And you can also contribute from your donor advised fund electronically to their cause, and you don't have to give them cash, check, or credit card. Number two, you can donate appreciated securities. So rather than utilizing the route of using cash, check, and credit card, you can take appreciated securities from your portfolio and you can donate those to your donor advised fund or to the charity of your choice. And you're not going to pay capital gains. The charity is not going to pay capital gains when they sell those securities. And then you're going to get a donor advised tax credit. So you get to have impact, you get to avoid capital gains, and you get a receipt there for your charitable contributions. So it's a double whammy. Next thing is you can do the same thing if you're one of those incorporated professionals and you save money in your holding company and you have your portfolio there. You can donate appreciated securities from your corporate investment account over to your donor advised fund or to your charity, and you're going to get the benefit of not paying capital gains at transaction. The charity is not going to pay capital gains, and they're going to take your contribution. You're going to get a a donation tax credit and a receipt for the corporation. But on the corporate side, you're also going to get a CDA credit. So that capital dividend account credit allows you to pull money out of your corporation and put it into your personal pocket tax free. That's awesome. Triple whammy. Next is if you are wrapping up a company at the end of the year, maybe you've paid out all of your loans or you've refinanced some stuff, and you no longer need an old life insurance policy that was used as collateral. Maybe it was a key man insurance, maybe it was there for a loan, and you no longer need it. Well, you've paid into it for a few years. You don't want to cancel it and just lose the value and all the cost that's gone into that. You can actually donate that old life insurance policy to a charity and sometimes to your donor advised fund. And then you're going to get the tax credit for that. And it may be hundreds of thousands of dollars. So you can turn a loss into a massive tax receipt. And you're doing a huge, huge benefit to the charity of your choice. Maybe you're going to donate it to your local hospital or something like that and have impact in your community that way. Lastly, we've had a few clients that we've dealt with. They're executives, they're high ranking employees of a company that they've been there for a long, long time. And they're rewarded with a SOP program or a share ownership program. How do you get money out of there and how do you do it tax efficiently? It really depends on the type of account that you have set up. But one of the things that we've been doing is taking some of that appreciated portfolio in your share ownership program and donating that either to your charitable cause or to your donor advised fund so that you get the benefit of no capital gains at transaction. The charity doesn't pay capital gains. You're going to get a donation tax credit. And then you can go back and you can either rebalance your program by pulling some of that SOP money out and putting it into your other investments, or you can pull that money out, use it for lifestyle expenses, etc. And so those are a couple of things that you can look at for the end of the year is are these maneuvers that we can make Are there benefits to doing it now? And a lot of the times there are, and we get very busy in the last couple of weeks of December when people realize this is the last few weeks of the year to do some charitable contributions. We'd like to start having the conversation with you and your team now so that we can prepare and look at what's the most advantageous, where do you get the most latitude for the decisions that you make and the most benefit. If this is something that you're interested in, please feel free to reach out. My name is Tyson with Portfolio Planning. Thank you.